Imagine you've just been fired, not just from any job, but from a prestigious firm on Wall Street. You're a Harvard graduate, but that degree suddenly feels like just a piece of paper. You have no job, no income, and your career seems to be crumbling before it's even begun. But this isn't the end of the story. For Ray Dalio, it was the beginning of an extraordinary journey, one that would see him rise from a fired analyst to the founder of the world's largest hedge fund, Bridgewater Associates. How did he do it? How did he turn rejection into revolution? And what did he discover about life, success, and failure along the way?
In 1975, Ray Dalio founded Bridgewater Associates in his New York apartment. It is now the world's largest hedge fund, managing $150 billion.
Biggest hedge fund in the world is Bridgewater Associates. Ray Dalio has built a personal fortune of $17.4 billion based on its success.
Ray Dalio wasn't born into wealth, nor did he have the typical pedigree one might expect from a future titan of finance. His story begins in the unassuming neighborhood of Jackson Heights, Queens, New York, where he was raised by a jazz musician father and a homemaker mother. Dalio's early life was far from the fast-paced world of Wall Street. It was grounded in the working-class ethos of his parents, who instilled in him the values of hard work and perseverance. But Dalio was no ordinary kid. From a young age, he was drawn to the world of investing, not out of a desire for quick riches, but out of sheer curiosity. At the age of 12, he started caddying at the local Links Golf Club, where he overheard many conversations about the stock market. Fascinated by what he was hearing, Dalio decided to try his hand at investing. Using the money he earned from caddying, he made his first investment in Northeast Airlines.
The first company I bought was a company by the name of Northeast Airlines. Northeast Airlines was the only company I heard of that was selling for less than $5 a share.
Not because he had any deep understanding of the company, but simply because it was the only stock he knew of selling for less than $5 per share. He thought the more shares he could buy, the more money he would make. It was a naive strategy, but by sheer luck, the company was acquired just as it was on the brink of bankruptcy, and Dalio ended up tripling his money.
And I tripled my money, and I was hooked. And I thought, this game is easy. With time, I learned this game is anything but easy.
This beginner's luck ignited a passion that would shape the rest of his life, sparking a fascination with the stock market's ability to grow wealth through analysis and strategy. Dalio continued playing the stock market through his high school years, initially buoyed by his early success with Northeast Airlines. However, his luck began to shift as 1966 marked the market peak, and over the next decade, the economy faced a series of downturns. From 1967 to 1979, bad economic surprises led to significant declines, and Dalio found himself repeatedly buying into a bear market, only to lose money. These setbacks were humbling. He realized that what he thought he knew about investing was only the tip of the iceberg. This period taught him vital lessons about crowd behavior, how expectations are priced into the stock market, and how people are often biased by their most recent experiences. During this challenging period, Dalio discovered transcendental meditation, which became a lifelong tool for achieving calm, open-mindedness, and clarity in his thinking. It allowed him to navigate his setbacks with resilience and develop a more creative approach to problem-solving.
Transcendental meditation I would attribute it to giving me more success than any other thing that I've had in my life. Well, meditation has given me centeredness and creativity.
He would continue to use this technique throughout his life, crediting it with helping him maintain a balanced perspective in the high-stakes world of finance. Dalio's formative years were marked by another significant event, the Vietnam War.
Tonight, for the first time in 27 years, the United States has again started a draft lottery.
As he was finishing his undergraduate studies at Long Island University, he received a draft notice. His father, a veteran of both World War II and the Korean War, was strongly against the Vietnam conflict and didn't want to see his son sent overseas. He arranged for a medical examination that ultimately led to Dalio being exempted on the grounds of hypoglycemia. This twist of fate not only kept him out of the war, but also allowed him to continue pursuing his passion for finance. In 1971, shortly after graduating from Long Island University's C.W. Post College, Dalio was further shaken by another pivotal event: President Nixon's announcement that the United States would no longer allow dollars to be converted into gold, effectively ending the Bretton Woods system.
Speculators. I have directed Secretary Connally to suspend temporarily the convertibility of the dollar into gold or other reserve assets
This
Except-
Nixon shock instilled in Dalio a deep skepticism of government policymakers and strengthened his resolve to understand the complexities of global markets. Dalio went on to earn an MBA from Harvard Business School, starting his journey into the heart of the financial world. However, his time at Harvard was marked by a series of notable economic events that would shape his future in finance. Following the end of the gold standard, a wave of money printing led to a risk-on environment, and the stock market soared. At the time, the Nifty 50 stocks, a group of large-cap growth stocks, were all the rage. Yet true to his contrarian nature, Dalio chose to focus on commodities, sensing that the era of easy credit and debt-financed overspending could not last. Dalio secured a summer job at Merrill Lynch in their commodity futures division, where he began to deepen his understanding of this market. His instincts were soon proven correct.
The oil-producing countries of the Arab world decided to use their oil as a political weapon,
resulting in their decision to reduce the flow of oil to America and other nations supporting Israel.
In his second year at Harvard, the first oil shock began, triggering an inflationary surge. The Federal Reserve responded by tightening monetary policy, leading to the worst stock market decline since the Great Depression. With stocks falling out of favor, commodities emerged as the new investment frontier, and Dalio's experience at Merrill Lynch made him a sought-after candidate. After graduating from Harvard, Dalio was quickly hired by the prestigious brokerage firm Dominick & Dominick as their director of commodities. Unfortunately, the firm, which had been a stalwart on Wall Street for over 100 years, collapsed due to the tumultuous market conditions before Dalio could establish a track record. It was also during this period that he met his future wife, Barbara, who would become a central figure in his life. Determined to make a name for himself, Dalio joined a larger brokerage firm that eventually became Shearson Hayden Stone. But his tenure there was short-lived, just over a year. Known for his bold, unfiltered approach, Dalio did things like hiring a stripper to add drama to his lecture at a financial convention, and even reportedly punched his boss in the face. These antics, while garnering attention, ultimately led to his dismissal.
And I sort of got drunk on New Year's Eve with the boss, and we were pushing each other around. I decked him. He went down, had a black eye, totaled his car, his wife chewed him out, blah, blah, blah.
A moment that could have been a setback, but for Dalio, it was simply another pivot point. He saw this as an opportunity to break free from the constraints of traditional finance and forge a new path, one where he could implement his unorthodox ideas without compromise. This determination to go against the grain would soon set the stage for the creation of Bridgewater Associates, the hedge fund that would redefine the industry. Dalio's journey to founding Bridgewater Associates was marked by a willingness to challenge the norms of Wall Street and a determination to find his own way. In 1975, at the age of 26, Dalio formally established Bridgewater Associates in his two-bedroom Manhattan apartment, but this wasn't the first time the name Bridgewater had been used. After graduating from Harvard Business School, Dalio initially started a business with a friend to sell U.S. commodities abroad, dubbing it Bridgewater because they aimed to bridge the waters between markets. The venture didn't take off, but when Dalio decided to go out on his own, he used the existing business entity to start his new firm. In the early days, Dalio relied heavily on his network, offering consulting services to clients he had built relationships with during his previous stints at various firms. Despite being fired from his last job, his former colleagues and bosses still respected his financial insights and were willing to pay for his advice. This network allowed Dalio to sustain his fledgling business and gave him the initial boost he needed to start Bridgewater on a solid footing. 2 years into this journey in 1977, Dalio married Barbara, the woman who had become his partner both in life and in navigating the complexities of the financial world. For their honeymoon, Dalio didn't choose a typical destination. Instead, he took Barbara to Moscow, where he saw an opportunity to combine business with pleasure. He had arranged meetings with Russian clients who were actively purchasing large quantities of grain and seeking his expertise. This unorthodox choice for a honeymoon highlighted Dalio's relentless drive to seize every opportunity, even during what was supposed to be a personal celebration. Bridgewater's early days were far from glamorous. Dalio's primary business focused on helping clients manage risk exposures, but he quickly found that many of them were also seeking his opinions on market trends. As these inquiries became increasingly time-consuming, Dalio realized it would be more efficient to consolidate his thoughts into a daily written commentary. Thus, he began creating what he called Daily Observations, a newsletter filled with sharp analysis on global markets and economic trends. which he sent out to interested clients via telex. This method allowed him to efficiently communicate his market insights while focusing on his core business. Over time, daily observations gained a following and became a critical communication tool for Bridgewater, helping to establish Dalio's reputation as a thought leader in finance. He continued this practice for decades, and over time it became a defining feature of Bridgewater's client communications. One of Bridgewater's early breakthroughs came when McDonald's was planning to introduce the Chicken McNugget in the early 1980s.
New Chicken McNuggets! Chicken McNuggets! And they're here.
However, the fast food giant was hesitant to bring the product to market due to concerns about fluctuating chicken prices, which could erode their profit margins. Dalio, always keen to solve problems by understanding them as systems or machines, dove into the root causes of the price volatility. He discovered that the biggest factor causing the fluctuation in chicken prices was the cost of feed, primarily corn and soy meal. Dalio worked closely with chicken producers, showing them how they could use a combination of corn and soy meal futures to lock in feed costs and provide McDonald's with a fixed price for chicken. By reducing the price risk through this innovative approach, Dalio enabled McDonald's to confidently proceed with the launch of the Chicken McNugget. This deal not only saved McDonald's millions of dollars, but also established Bridgewater's credibility in the corporate world. Other giants like Nabisco soon sought Dalio's expertise, and Bridgewater began to gain significant traction in the industry. But success was not without its lessons. In 1982, Dalio, convinced that a global recession was imminent due to overextended loans to emerging Latin American countries, made a high-stakes prediction. His analysis was rooted in the belief that Mexico's default on its debt would trigger a cascade of defaults across other countries, similarly over-leveraged with American banks.
We have been facing a liquidity problem.
As Mexico declared its inability to service its debt, Dalio anticipated that the Federal Reserve's initial response to increase the money supply to manage the crisis would eventually fall short. He feared that the economy could collapse or, worse, spiral into hyperinflation if the Fed continued its stimulus efforts too aggressively. Confident in his forecast, Dalio positioned himself accordingly, buying gold and treasury bill futures, essentially a strategy to profit from worsening credit problems. However, his bet proved disastrously wrong. As money flowed out of debtor countries and into the United States, the dollar strengthened, creating deflationary pressures. This unexpected deflation allowed the Fed to lower interest rates without igniting inflation, which in turn fueled a market boom and led to one of the greatest periods of non-inflationary growth in U.S. history. Dalio was publicly wrong, and his miscalculation dealt a severe blow to both his reputation and his finances.
You were recently quoted in an article. You said, "I can say this with absolute certainty because I know how markets work."
The firm's losses were so substantial that he was forced to let go of all his employees, unable to make payroll. At a personal low, Dalio had to borrow $4,000 from his father to support his family until he could sell his second car. With a wife and 2 young children to support, this was not just a setback, it was a turning point.
I was so arrogant and I was so wrong.
After 8 years of running Bridgewater, he had little to show for it and found himself contemplating a return to a conventional job, acutely aware that every decision he made going forward would profoundly impact his family's future. This humbling experience forced Dalio to confront his own fallibility. The sting of being so publicly wrong and nearly losing everything pushed him into a period of deep introspection. He began questioning his assumptions, recognizing that his greatest failures often stem from his own overconfidence.
Rather than thinking I'm right, I started to ask myself, how do I know I'm right?
It was during this period of reflection and self-examination that Dalio began to formulate his principles of radical honesty and transparency. Principles that would become the bedrock of Bridgewater's unique culture and guide its path forward. Despite being at his lowest, Dalio decided not to give up. Instead, he committed himself to a different approach, one that involved seeking out dissenting opinions, learning from mistakes, and embracing the reality that there was always something he didn't know. This mindset would prove to be transformative, allowing him to rebuild Bridgewater with a stronger foundation rooted in continuous learning and open dialogue.
I mean, honestly, what was the horror for me was, am I really going to put on a tie and get on a commuter thing and go to Wall Street and do that? Ooh, I don't think that's going to be. So I pushed through it, and but I learned fear of being wrong then.
Reeling from the 1982 debacle, Dalio started to rebuild Bridgewater Associates with a renewed sense of purpose and clarity. Despite the setback, the firm began to find its footing in the financial world. Dalio's commitment to transparency, honesty, and learning from mistakes began to attract a new type of client, those who valued Bridgewater's unconventional approach to investing and risk management. While the late 1970s had already seen Bridgewater gain some recognition for its unique strategies, it was in the aftermath of Dalio's 1982 ordeal that the firm's transformation into a financial powerhouse truly began. Dalio's period of reflection led him to develop a systematic, data-driven approach to investing, where mistakes were opportunities for growth and success was built on the foundation of rigorous self-examination and truth-seeking. Faced with the consequences of his failed prediction, Dalio adopted a new philosophy, treating the economy like a machine that operated according to specific patterns and principles. He delved deep into economic history, using data-driven methods to analyze how various factors influence markets over time. Dalio's obsession with systematic, data-driven decision-making extended beyond just economic analysis. To drive home the point to his clients, he once had Bridgewater send out inexpensive chess computers from Radio Shack, accompanied by a note, a systemized approach from Bridgewater. The message was clear. Just as a computerized chess game could calculate countless moves and strategies more quickly than any human, Bridgewater was relying on systematic computerized models to make business decisions. Dalio wanted his clients to see the power of algorithms and models, but also how hard it is to beat a well-programmed decision-making process. However, Dalio didn't entirely discard the human element. While Bridgewater increasingly relied on computerized models that were continuously fine-tuned, Dalio believed that computers lacked imagination, intuition, and the nuanced understanding that humans could provide. He maintained that a hybrid approach, combining the data-driven rigor of algorithms with the creativity and logic of human insight, would yield the best results. This balance between technology and human intellect became a defining feature of Bridgewater's investment strategy and culture. By the mid-1980s, Bridgewater was making good money selling research packages and successfully managing their clients' interest rate and currency exposures. However, they had not yet entered the realm of institutional investment management. This all changed when Dalio made a bold pitch to the people running the World Bank's pension fund. Despite having no assets under management and no formal track record, Dalio convinced them to give Bridgewater a $5 million bond account to manage. This moment was a significant turning point, marking the start of Bridgewater's transformation into what it is today. The firm's success with the World Bank account quickly attracted other large institutional investors, such as Mobil Oil and Singer. Bridgewater's innovative strategies and strong performance results soon propelled them to become the top-performing U.S. bond manager in the world. The firm's reputation for strategic foresight and rigorous risk management was further solidified on Black Monday, October 19, 1987.
They're calling it the Monday Massacre, the worst drop in Wall Street history.
On that day, the stock market experienced its largest single-day percentage decline till date, leaving many investment managers reeling. However, Bridgewater was one of the few firms that had anticipated the crash and positioned itself accordingly, having taken short positions on stocks ahead of the event. As a result, Bridgewater's portfolio was up 22%, while most others were down significantly. The media hailed them as the heroes of October, thrusting the firm into the spotlight and earning Dalio and his team a reputation for being able to navigate the most turbulent market conditions with precision. Riding this wave of success, Bridgewater continued to innovate and expand its offerings. In 1989, the firm launched its flagship fund, Pure Alpha, which was designed to apply its data-driven, diversified investment strategy across multiple asset classes. Pure Alpha quickly became a benchmark in the hedge fund industry, attracting more clients and solidifying Bridgewater's standing as a leader in global finance. Bridgewater's rise during this period was not just about the numbers, it was also about the culture that Dalio was meticulously crafting. He codified the principles that had guided his recovery from near bankruptcy, promoting a culture of radical transparency where every idea could be challenged and every decision was open to scrutiny. Meetings were recorded, feedback was expected, and all employees were encouraged to think independently and voice their opinions. But as Bridgewater continued to grow, Dalio faced the challenge of scaling the firm while maintaining its unique ethos. He began delegating day-to-day responsibilities to a formal leadership team.
Welcome, Bridgewater. I love you.
Yet his commitment to radical transparency never wavered. Dalio's leadership style, marked by a relentless focus on open-mindedness and meritocracy, helped build a firm that was both innovative and resilient. By the end of the 1980s, Bridgewater had evolved into a formidable force in the financial world, known for its unconventional practices and groundbreaking strategies. Another pivotal moment in the firm's rise came in 1990 when Bridgewater signed a $100 million account for Kodak's pension fund. Rusty Olson, the chief investment officer of Kodak's pension fund, had been purchasing research from Bridgewater for some time. However, in 1990, he approached Dalio with a unique problem. Kodak's portfolio was heavily invested in equities, and Olson feared they were overexposed if markets took a downturn. Dalio and his team worked through the weekend, meticulously analyzing Kodak's pension fund and developing a tailored hedging strategy built on innovative portfolio engineering ideas. The proposed solution not only addressed Kodak's concerns, but also impressed Olson enough to entrust Bridgewater with the $100 million account to manage. This deal not only brought significant credibility to Bridgewater, but also provided a stable stream of income from management fees, further solidifying its standing among major institutional investors. The lessons learned during this period, from the humbling 1982 loss to the triumphs like the Kodak deal, cemented Dalio's reputation as one of the most innovative thinkers in finance. His ability to turn setbacks into learning opportunities and combine unique strategies with a principled approach to management set Bridgewater on the path to later becoming the world's largest hedge fund. With Bridgewater's rise in prominence during the late 1980s and early 1990s, the firm's profile grew rapidly. By 1995, Bridgewater had expanded to 42 employees and was managing $4.1 billion in assets. However, success brought new complexities. Dalio, who had built the firm on principles of radical transparency and systematic decision-making, now faced the challenge of scaling these values across an ever-expanding organization. The transition from managing a boutique advisory firm to leading a large-scale operation meant confronting difficult questions about leadership, organizational structure, and maintaining the firm's unique culture. A central focus during this time was refining Bridgewater's investment systems. Since the early 1980s, Dalio had been methodically building and improving the systematic, data-driven models that set Bridgewater apart from its competitors. These models served as the foundation for some of Bridgewater's most successful strategies, including the Pure Alpha strategy, which had transformed the firm in the 1980s. Pure Alpha focused on balancing risk across multiple asset classes rather than betting on individual stocks or market sectors, allowing Bridgewater to achieve consistent returns regardless of economic conditions. In addition to Pure Alpha, Bridgewater introduced two more groundbreaking strategies during this period: Alpha Overlay and All Weather. The Alpha Overlay strategy focused on separating alpha, excess returns from active management, from beta, market returns. This approach allowed institutional investors to enhance returns without taking on additional market risk. Meanwhile, the all-weather strategy, developed as a response to Dalio's desire to create a portfolio that could perform in any economic environment, became a hallmark of Bridgewater's reputation for risk-parity investing. This approach relied on balancing asset classes in a way that would protect the portfolio against various market conditions, essentially creating a safer and more stable way to manage large-scale investments. As Bridgewater's assets under management grew, so did Dalio's ambitions. By the mid-1990s, Dalio's success had given him enough financial security to establish a trust for his family, and he began thinking more seriously about strategies to preserve generational wealth. His focus turned to long-term investing, emphasizing stability and sustainability, which led to further refinement of the all-weather strategy. This personal shift also influenced Bridgewater's approach to investment risk, as Dalio sought ways to balance high returns with lower risk, aligning with his new goals for family wealth preservation. However, as Bridgewater grew, so did the complexities of managing a larger organization. Dalio faced the challenge of maintaining the firm's rigorous culture of radical transparency and meritocracy. What had worked well in a small firm now required more formalization and a broader buy-in from employees. To address this, Dalio codified the principles that had guided the firm's success into a document, later published as Principles, Life and Work. This guide was intended to ensure that every employee, regardless of their position, operated with the same set of values. Yet scaling this unique culture across a growing workforce was no easy task. The firm's expansion also necessitated changes in leadership. Dalio, who had been heavily involved in every facet of Bridgewater's operations, began recognizing that he could no longer manage everything himself. This realization prompted him to delegate more responsibilities to trusted colleagues, but the process of transitioning leadership was fraught with difficulty. Dalio's first significant attempt to share leadership came when he appointed his longtime collaborator Bob Prince as co-chief investment officer. While Prince had been deeply involved in Bridgewater's investment philosophy, the transition tested Dalio's ability to relinquish control. As the hedge fund industry became increasingly competitive in the 1990s, Bridgewater continued to innovate. Dalio's obsession with understanding the economic machine drove his team to develop cutting-edge analysis of global trends, ensuring that Bridgewater stayed ahead of competitors. The firm's Pure Alpha fund consistently delivered strong returns, even in turbulent markets, solidifying its status as a top hedge fund. By 2000, Bridgewater was managing over $32 billion, nearly 8 times what it had been managing just 5 years prior. The firm's ability to innovate while staying true to its principles allowed it to dominate the industry, even as new competitors emerged. Yet as Bridgewater's assets continued to grow, so did the challenges of maintaining its unique culture and leadership structure. By 2005, Bridgewater Associates had ascended to become the world's largest hedge fund, a feat accomplished through its innovative strategies and the firm's unparalleled commitment to radical transparency. From 1991 to 2005, Bridgewater had only 3 calendar years where it lost money, and in those years the losses never exceeded 4%. This consistency positioned Bridgewater as a powerhouse in the financial world, but it also placed immense pressure on the firm to maintain its edge. With its growing stature, Bridgewater faced not only external challenges, but also internal strains as the organization expanded rapidly. However, success brought new complexities. While Bridgewater emerged as a trusted advisor to institutional clients and pension funds, its rapid expansion tested the principles that had once set it apart. Dalio's commitment to radical transparency, which had served the firm well in its early years, was now being challenged by the sheer scale of operations. By 2008, Bridgewater employed 738 people, and the demand for transparency across such a large organization began to weigh heavily on both Dalio and his team. Dalio himself was working 80-hour weeks, overseeing both the investment side and the company's operations. It became too much. In a candid moment of vulnerability, Dalio sent an email to the management committee, copying the entire company in which he admitted, "I am escalating to let you know that I have reached my limits and that the quality of my work and my work-life balance are both suffering unacceptably." It was a rare glimpse of Dalio confronting the human cost of trying to maintain a firm that was simultaneously a financial juggernaut and a social experiment in radical transparency. Even as the internal pressures mounted, Bridgewater continued to thrive in the markets. By the mid-2000s, Dalio had developed a deeper understanding of economic history, studying past cycles with the belief that historical patterns would repeat.
I took history books and records of old newspapers, and I went day by day through the Great Depression, through the Weimar Republic, because I knew that the same things happen over and over again.
This long-term perspective led him to include a depression gauge in Bridgewater systems in the early 2000s.
8 years before it, we put together something that we call the depression indicator,
a tool designed to signal the risk of an economic collapse. By 2007, this gauge started flashing, indicating that a debt bubble was nearing its breaking point. Dalio's historical analysis suggested that the world was heading toward a major financial crisis, and he believed this would play out much like previous debt busts.
The knowing that I don't know if it's the big one.
In his mind, the cost of servicing massive amounts of debt was outpacing projected cash flows, and with interest rates near zero, central banks had little room to ease monetary policy.
Don't look good, but still, I'm never sure.
This realization brought back haunting memories of his failed 1982 prediction of a debt crisis, which had nearly destroyed him. Dalio was determined not to relive that failure. To navigate this looming crisis, Dalio devised a strategy that balanced the portfolios Bridgewater managed in such a way that there would be considerable upside and limited downside if his prediction was correct. At the same time, he made sure they had a backup plan in place if they were wrong. The result was a portfolio structured to weather the storm of uncertainty. When the great financial crisis hit in 2008, Dalio's careful preparation paid off.
Down by between 3 and 4.5% generally across these markets.
Let's talk about the speed with which we are watching this market deteriorate.
We're red everywhere, essentially, down by 4-5%.
We're down over 16%. Dow at the same time has fallen about 18%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
Bridgewater's flagship fund posted a return of over 14%, a staggering achievement in a year when many investors were printing losses of 30% or more. Dalio's balanced approach had worked, preventing the firm from being overly exposed to risk while still capitalizing on the downturn. Bridgewater could have made even more money if Dalio had taken more aggressive positions, but he had no regrets about playing it safe. For him, the lessons of 1982 were still fresh, and he knew the importance of managing both risk and humility in the face of market uncertainty. While Bridgewater's investment success during the crisis cemented its status as one of the best hedge funds in the world, the internal strains of managing such a vast organization, with its commitment to radical transparency, were beginning to show. Dalio's principals had built an extraordinary firm, but they were also creating a pressure cooker environment. Would the culture of radical transparency survive as Bridgewater continued to grow, or would the firm need to adapt to the changing realities of success and scale? This question loomed large as Dalio and his team prepared to navigate the challenges ahead. By the late 2000s, Bridgewater Associates had cemented its position as the world's largest hedge fund, but this success brought with it challenges of scale and leadership. In 2010, Bridgewater's performance hit an all-time high, with returns of nearly 45% and 28% in its pure alpha funds and close to 18% in the all-weather fund. Yet, as the firm's client base expanded, managing so much capital became a problem. Dalio and his team faced the paradox of being too successful, having to return money to clients when they were eager to invest more. Handling too much capital risked influencing the markets and damaging performance. To address this, Bridgewater introduced a new product in 2010, Pure Alpha Major Markets. It followed the same strategy as the original Pure Alpha Fund, but only invested in the most liquid markets to maintain flexibility. Despite its popularity, even this new fund had to close to new investors by 2011 due to overwhelming demand. At the same time, Dalio began to transition out of day-to-day management. At 60, after 35 years of running Bridgewater, he was ready for new adventures, like spending more time with family and exploring personal interests like ocean exploration and philanthropy. His plan was to step back from his roles as CEO and CIO, but he wanted to mentor his successors. On the first working day of 2011, Dalio officially announced to the company that Greg Jensen and David McCormick would replace him as co-CEOs, marking the beginning of his gradual exit from operational leadership. That same year, Dalio took a significant step to demystify Bridgewater's much-criticized culture by publishing principles on the firm's website. Bridgewater had garnered media attention for being a cult, and Dalio wanted to explain the reasoning behind its radical transparency. His goal was to make sure the public understood what Bridgewater stood for and how its principles shaped the firm's success. However, the leadership transition was not without challenges. In 2010, Bridgewater hired former federal prosecutor Jim Comey as a new senior leader, but integrating him into the culture proved difficult. Comey struggled to adapt to Bridgewater's radical transparency, where every meeting was recorded and decisions were publicly scrutinized. Despite his admiration for the firm's intellectual rigor, he found the level of openness and lack of privacy overwhelming. His experience highlighted a tension within Bridgewater. How could the firm stay true to its principles while accommodating new leaders from different backgrounds? As Bridgewater grew and its leadership evolved, the firm stood at a crossroads. Could it continue to operate with the same level of radical transparency and adherence to Dalio's principles, or would it need to evolve? The leadership transition that began in 2010 proved more turbulent than anyone anticipated. Greg Jensen, once seen as Dalio's chosen successor, faced mounting pressures in his dual roles as co-CEO and co-CIO. Dalio's expectation that Jensen would be able to carry the weight of both positions strained Jensen's leadership and contributed to rising tensions within the firm. Despite Bridgewater's stellar financial performance, with returns that continued to impress clients, including the introduction of the Pure Alpha Major Markets Fund, internal leadership dynamics were faltering. In March 2016, Dalio had to step back into his role as co-CEO. temporarily replacing Jensen to help stabilize operations. Dalio would later describe this as one of his greatest regrets, admitting that he had placed too heavy a burden on Jensen by expecting him to handle both the operational and investment sides of the firm simultaneously. Amid these struggles, Dalio remained committed to mentoring the next generation of leaders at Bridgewater. His fascination with shapers, as described in Joseph Campbell's The Hero with 1,000 Faces, influenced his approach to succession. He saw leadership as a journey, one where, after facing trials and challenges, the hero returns to give back the boon. In Dalio's case, his boon was the knowledge and principles he had cultivated over decades.
Well, the greatest reward is seeing the people that you care about do well independently of you.
Although the leadership transition proved more difficult than expected, Dalio's desire to step back from the daily grind was genuine. His long-term vision was to guide the firm through this evolution while focusing more on personal pursuits like philanthropy and thought leadership. Bridgewater's culture of radical transparency, which had helped the firm rise to prominence, was beginning to show its limitations. While it fostered intellectual rigor and accountability, it also created an environment that could be overwhelming. Employees like Joe Sweet, initially drawn by Bridgewater's reputation for excellence, found the constant evaluations and lack of privacy stifling. Sweet's mental health deteriorated, highlighting the toll that Bridgewater's intense feedback culture could take on individuals. At the same time, Bridgewater faced broader leadership tensions. The year 2016 saw Dalio stepping back into the co-CEO role to assist Greg Jensen. But this move sparked renewed internal discord. Leaders like co-CEO Eileen Murray found themselves under increased scrutiny. The infamous Eileen Lies investigation, which lasted 9 months, led to her demotion and fueled debates about whether the firm's transparency policies had become overly invasive. Despite these internal struggles, Bridgewater continued to perform well in the markets. The launch of the Optimal Portfolio in 2015, Bridgewater's first new product in over a decade, was a testament to the firm's ability to innovate. The Optimal Portfolio Fund was designed for a low-interest rate global macro environment, and its launch was the largest in hedge fund history at the time. Yet the pressures of managing a sprawling organization weighed heavily on Dalio and his team. Even as they adapted their strategies and managed assets in increasingly sophisticated ways, the firm's unique culture was facing unprecedented challenges. Radical transparency had become a double-edged sword, and the question remained, could the firm continue to thrive while maintaining its core identity? As Bridgewater continued to evolve, Dalio began to reflect on the firm's guiding principles. The culture of radical transparency, while instrumental in the firm's success, had also led to controversies and internal tensions. Dalio recognized that his principles needed refinement as the firm grew in size and complexity. In response, Dalio began to publicly share his principles more widely. His 2017 book, Principles, Life and Work, offered a deeper insight into the values that had shaped Bridgewater. The book became a bestseller, helping Dalio broaden his influence beyond the hedge fund world. Around this time, Dalio also expanded his reach through educational videos, most notably his How the Economic Machine Works video.
Well, it's in 30 minutes, a description of how I believe the economic machine works.
These videos sought to explain the macroeconomic principles that underpinned his investment strategies.
How the Economic Machine Works in 30 minutes.
The success of these initiatives helped Dalio to return the boon by passing his knowledge to a wider audience. Bridgewater, under the leadership of co-CEOs Greg Jensen, David McCormick, and later Nir Bardea, began to adjust its approach. The firm experimented with new methods to balance radical honesty with empathy, aiming to maintain its high standards while reducing the risk of burnout among its employees. Dalio's shift in focus, away from day-to-day operations and toward thought leadership, marked a new chapter in Bridgewater's evolution. As Dalio transitioned out of the leadership role, Bridgewater faced the challenge of maintaining its unique culture while continuing to innovate. Dalio's influence remained strong through his books, philanthropy, and educational work. His foundation, the Dalio Foundation, had committed over $5 billion to causes such as healthcare equality, ocean conservation, and education. Dalio's philanthropic endeavors paralleled his intellectual contributions. He was committed to giving back, both financially and through his thought leadership. In 2011, Dalio and his wife joined Bill Gates and Warren Buffett's Giving Pledge, promising to donate more than half half of their fortune to charitable causes. Bridgewater, under the leadership of new CEO Nir Bardea, continued to navigate the challenges of a rapidly changing financial world. The firm remained committed to Dalio's principles, but it was also learning to adapt, embracing new opportunities in a world shaped by technological advancements, regulatory changes, and geopolitical shifts. Dalio's journey from a young boy fascinated with the stock market to the founder of the world's largest hedge fund is a testament to the power of resilience, innovation, and leadership. His ability to learn from failure and to turn setbacks into opportunities exemplifies a deep commitment to growth and understanding. At the core of Dalio's legacy are the principles he lived by: radical transparency, meritocracy, and continuous learning. These values helped Bridgewater stand out, not just as a hedge fund, but as a laboratory for new ideas in leadership and organizational culture. Dalio's hero's journey was not just about personal success, it was about passing along the boon to others. Through his books, videos, and philanthropic efforts, Dalio has ensured that his ideas will continue to influence future generations, both in finance and beyond. As Bridgewater moves into its next chapter, the question remains, can Dalio's principles continue to guide the firm, or will they need to evolve further in response to a rapidly changing world? The lessons from Ray Dalio's journey are clear. True success lies not just in financial achievement, but in the lasting impact of one's ideas, principles, and willingness to share the journey with others.